Okay, so capital investments, that's when companies take their money, they use it to purchase long-term assets or do some other sort of investment, right? They might be investing in the company by buying equipment or buildings or land or things like that, or they might be investing in some project, some new product that they're going to create, expanding the company to other markets, whatever it is. They're investing large sums of money with the intention of increasing the company's value, right? And so these are capital investments, as opposed to the normal expenses just of running the business day to day. So we learned about how first they screen out any alternatives that do not meet their minimum requirements, right? So they make screening decisions. And then those options that do meet their minimum requirements, they can then look at more closely and by preference decide which ones they're going to pursue. And so a big part of this chapter is using different analytical tools to help make those decisions, right? So first we looked at a couple approaches that do not use the time value of money. They're just very short, simple approaches, like the payback method, to see how long it's going to take this investment to pay itself back as just a rough estimate, right? And accounting rate of return, what percentage return can you expect from this investment? Again, it's a rough estimate, it's not very precise. Here was the formula for the payback period. You take your initial investment, divide it by net cash flow. And the way you get your net cash flow is you take the amount of extra cash that's coming in minus the amount of extra cash going out, right? So that'll give you an answer in years, and how many years you can expect before this investment pays itself back. If the cash flows are not even, if you're expecting uneven cash flows, then you have to go year by year, right? You have to start with your initial investment, subtract the incoming cash until you get close to zero. And then when you get close to zero, you take the amount that's remaining that you still need to reach that payback point, divide it by your expected net cash flow for the following period. That gives you a fraction. And so you know down, to a pretty precise point how many years it's going to take you for the project to pay back. Of course, this is all based on estimates, right? But in this case, they're expecting this investment to pay itself back in 5.33 years. And then you can compare that to your requirements. If your requirements say 5 years is okay for a payback period, but anything above that is not okay, then this does not meet the requirements, right? But if your cutoff was 6 years, then you're okay, because you're within that period. So then we got to accounting rate of return. This also uses the initial investment, but in this case, it is the denominator, right? The one on the bottom. And what you do is you take your incremental revenue, subtract your incremental expenses. So how much extra sales volume or sales dollars do we expect, minus how much extra cost we expect, divided by the investment cost. And this will give you a percentage, right? And that is your accounting rate of return, ARR. So those are pretty simple and straightforward. Again, they do not involve the time value of money, which is what? What is the time value of money? Why does money have a time value?
Because you can invest it for things now it's worth it later.
That's right. It's because if you invest money now, it'll be worth a different amount in the future, hopefully more, right? If you invest it wisely, it'll grow, usually. And so then we're factoring that into our equation. And this is really important with these long-term projects that might span multiple years, right? You want to take that into consideration and think, okay, I could do this project and maybe, let's say, once I factor in the time value of money, I find I'd be making a return of 10% per year. Okay, but if you had the option to just buy a bond that paid you 11% per year, that might be a better choice. Now, there aren't any 11% bonds that would be safe right now, so that's, it's just a made up number. But that's the whole point. If you want to be able to compare different options over different periods of time, you really want to factor in the time value of money so you can compare appropriately. So this uses the terms present value and future value. Present value is what something's worth today, and future value is what it will be worth at some point in the future, right? Like if you put money in the bank today and you're earning interest, what is that going to grow to in the future? And so we saw we have some different tables we can use for that. Let's see, what is this one? Oh, that was just about compounding interest. So here's an example of one of the tables, the future value of $1. When would you use this table? When you're investing $1? When would this table be useful? Future value of $1. Okay, yes, when you're making a lump sum investment and you want to know what? The future value. Okay, exactly. We also had the future value of an annuity table. So that means you're going to be putting money in multiple times, like every year, and you want to know what that's going to grow to in the future. We also had present value versions of these, right? Let's see, are those coming up next? Discounting is the term for taking a future value and discounting it back to the present. So here's present value of $1. When would you use this table? Say a little louder, Joe. I think. Yeah, exactly. So if you know what future value you want to have in the future, how much would you need to invest today, one time, so that it will grow to that amount? Or, let's see, present value of an annuity, if you're going to be putting in, how much would you need to put in at a regular amount to reach a certain future value? Or we've seen, like, I think this is one of those bank examples where how much could you borrow from the bank today if you can afford to pay them back $1,200 a month or a year for 5 years? You could use it that way as well. All right, and what else did we cover? Oh, so then we learned net present value. We already know what present value is, right? Taking some future value and discounting it back to the present. Net present value just takes it a step further and takes your expected cash flow, discounts it back to the present, and then subtracts your initial investment. And that's why it's net, because it's the present value of your cash flows minus the investment. And if that is a negative number, it's not a good option, right? If it's a positive number, then it would be an acceptable option. So we also learned, oh, did we do any IRR? Maybe we didn't. We didn't do that, okay. We've talked about it, yeah. So we'll be doing those today, and we'll be using spreadsheets definitely for those calculations. Here's an example of net present value. So again, there's the initial investment, which is already in the present. And then there is the future cash flows. So using the present value of the annuity table, you can discount those cash flows today for the present value, subtract the original investment and get your net present value. Now, this is assuming your cash flows are even. If they're not, oh yeah, forgot about that. We'll come back to that. If they're not even, then what you have to do is use the present value of a dollar table. Go to the right column for whatever percentage you're working with and use those numbers from that column. And then you have to multiply every year's cash flow by the factor from the table. Or you could use a spreadsheet and it'll do it for you. So I skipped the profitability index. Let me go back to that. If you've got, if you're having a hard time comparing your different options, maybe because one is very large and one is very small, and so it's kind of hard to compare them side by side, or they've got similar net present values. Here's an additional tool you could use, your profitability index. Take your present value, divide by your investment. And what that tells you is how much you're earning for every dollar invested. And in this example, we see option A is earning more than option B. So it has a higher profitability index. So that might be enough to sway you and say, okay, well then let's do option A. All right, any questions? I know that's a lot. Like that's about as far as we got. Let me find the exact point where we stopped.
What's the present value of cash flows?
Just taking those anticipated cash flows and figuring out what they would be worth today.
Okay, so there's no like future value of cash flows, and that's not relevant.
You can, there's future value of an annuity, which would be cash flow. But you could probably even do it with uneven cash flows, but it would be less common that you would be predicting future cash flow that's uneven, right? I don't know. I guess you could do it, but I don't think there are any examples of it. Good question. You always ask the questions that make me think. Okay, so yes, we've got up to there. So let's go ahead, we'll cover this one, and then we've got an exercise after that. Okay. So this investment costs $135,000. It has annual cash flows of $40,000. So that's how much we're expecting every year in cash flow. And our expected interest rate is 10%. And it's a 5-year investment. So with all these considerations, we can calculate net present value. And then see, do we get a positive number? And that'll help us decide if we should do it or not. So where would we start? What would we do first? We're trying to figure out NPV. What do we do? Okay, so we know what the cash flows expected to be, 40,000 for 5 years. That's 200,000, right? But we have to figure out the present value, right? So how would we do that? Which tool or table would we use? Present value of, because it's 40,000 every year for 5 years, we'd use the present value of an annuity table, right? If it were uneven cash flows, then we would have to use present value of dollar. We'd have to go year by year. But because it is even, it's an annuity. And so we would use present value of an annuity. All right, well, let's do it. Right? Why talk about it when we could actually do it? All right, so that means we go to the textbook. Link here, okay? We go down to the appendix, time value of money. And we go to present value of an annuity. Now, was it 10%? And 5 years, okay, so 10%, 5 years, 3.791. That's our factor. Okay, and what do we do with that number now? Thought I heard somebody. It's only been 2 days, y'all. What's that? By the investment? Actually, not the investment. So we're trying to discount the cash flows, right? So we're going to multiply it by our annual $40,000 cash flow. Okay, so we take our factor from the table, multiply by the annual cash flow. And that means that $200,000, right? It's 40,000 times 5 years, $200,000. The present value of that 200,000 is 151,640. Because we could just invest 151,640 at 10% interest and it would grow to 200,000 in 5 years, right? So we've taken those future cash flows and discounted them back to today. But that's just the present value. Now we need net present value. So what do we do next? This is where the investment comes in. We subtract the investment. So $16,640 is the net present value of this investment. If we invest that, what is it, $135,000, and we get that $40,000 a year for 5 years, that's equal to us taking $16,640 and just investing that at 10%. Now, you can't really get a guaranteed 10% on an investment today. But then there's really no guarantee that these numbers are right either, right? The 40,000 a year at cash flow is just an estimate. Who knows if it's really going to be 40,000 a year? But that's how we do it. So just to recap what we did, to find out net present value for this investment, we took the annual cash flows, which are even, it's the same amount every year. We went to the present value of an annuity table. Because we're using 10%, that's how much we feel we could get if we were to invest some other way. Or maybe it's our company's minimum investment rate. Okay, so that is the percentage we are going with for this calculation. So based on that 10% and the 5 years of this investment, we got the 3.791 factor. We multiplied that by our annual $40,000 cash flow. And now we have the present value of that cash flow, right? How much it would be worth if we just invested it today. And we wanted it to grow to 200,000. And then we subtracted our initial investment. And the number that we got is a positive number. So it would be an acceptable choice. Not necessarily the best choice, right? We don't know what our other options are. But if it were negative, we would definitely say no, because then we're getting less than a 10% return. So, any questions on that process? All right. So now we have an exercise, number 16. And we got up as far, I think we did number 13. So we haven't done 16. All right, well, this is a net present value calculation. So what we're going to do here, this project costs $5,000 upfront. So in year 0, that's $5,000 going out, right? So let's indicate that that's a negative number. And because that's happening in the present, then it's exactly $5,000, $5,000 of an impact, right? It's not a future value, it's a present value. So we just multiply by 1. So we keep it at $5,000. And then we have expected cash inflows. So this is what we think we will be earning in cash from this investment. 500 in the first year, 1,200 in the second year, 2,000 in year 3, 2,500 in year 4, and 2,000 in year 5. But what we have to do is now discount that back to today, to the present. How are we going to do that? What's that? Eventually, but first we have to discount it.
You could use the present value of an annuity table.
You're close. Because they're uneven, we can't use the present value of an annuity table. It would be present value of a dollar table, which is the first one. Now, it was an 8% interest rate, they said, right? 8%, so we're using the 8% column. And so what we're going to do here, see if I can fit these both on the screen. Oops. Okay, and then let's get this a little smaller. Okay, that might be kind of small, but that's all right. We just need it for a moment. So now we look at the 8% column. Again, this is the present value of a dollar table. So in year 1, the factor is 0.926. So we're going to put 0.926 here. In year 2, it's 0.857, right? So that's what we'll put in year 2. In year 3, it's 0.794, and so on. Okay. So that's how you have to do it in this case. Or you could use a spreadsheet, but if you're doing it manually, that's how you do it. When you have uneven cash flow, you take the cash flow for each year times that year's factor from the present value of a dollar table. And when you multiply, you just put your answer over here. So we have 500 times 0.926. And 1,200 times 0.857. And so on.
So we don't need a spreadsheet for this.
Right. You could do it that way, but since it's laid out this way, let's just go ahead and have the experience of going step by step. Okay, and then one more. Okay, so again, what we've done is we've taken these future values for the next 5 years, discounted them by multiplying by the factor from the table, and gotten the present values. And, do you see a pattern here? It keeps getting smaller every year, right? Because the farther out, like if we're talking about something 5 years from now, you'd have to invest a smaller amount today for it to grow to that amount, right? So the farther out you go, the more you're discounting to get to the present value. So now we can add up our original investment, which again is money going out, with all the money that we expect to come in, converted to present value, and get the net present value. All right, so I got $1,278.90. Let's see if that is the right answer or not. Should be in the ballpark. Okay, so they rounded off to 1,279. So for consistency's sake, we'll do that too. All right, so there we go. That is our net present value calculation. Would this be an acceptable investment? It's a positive number, so yes. Okay. Any questions on that process? All right. Looks like we have a problem next, problem 4. All right. So the company has a $25,000 overdue debt with a supplier. Not good, right? And the company is low on cash. It has only $7,000 in the checking account. This is actually not an uncommon situation in the business world. Sometimes you have a cash shortage. You have to figure out, how do we pay our bills? How do we keep our business in business? So we've talked to our supplier and we've got 2 options. One is if we pay them $7,000 now, which remember, that's everything we've got in the bank, and we pay them $23,750 in 2 years, they will be okay with that. Or we could pay them nothing today and pay them $35,000 in 3 years. Now, if our interest rate that we're dealing with is 8%, if that is basically what it would cost us to borrow the money or how much we could invest and expect to earn, if we're using this 8% interest rate, then we can compare these 2 options. But remember, one is over 3 years and the other one is over 2 years and also has an immediate cost. So now we have to factor in the time value of money. So the way we do that is we discount both of them to the present value. And then we can compare them and see which is really going to cost us more. So we have to figure out the present value of both of these options. Option 1, how do we discount that cost to the present value?
How do you multiply it by the value, the present value of the $1?
Exactly. Yeah, that's right. We know it's an 8% interest rate. We know this is in 2 years. And we know that this is just a one-time payment. So we go to our table. Make it bigger now. Okay, present value of $1, 8%, 2 years. That's the 0.857 factor. So So 0.857 times the 23,750. That has a present value cost of 20,353.75. So that's how much we'd have to invest today at 8% interest to have this amount in 2 years. But remember, we also would have to pay 7,000 today, which is already present value. So the net present value or the total present value with option one would be the combination $27,353.75. How would we do option two, which is $35,000 in 3 years? How would we get the present value of that? Is that same? Okay. We go to the present value of a dollar table, 8% again. We just go down to the 3rd year, which has a factor of 0.794. 0.794 times, was it 35,000? Oops. There it is. 35,000. That has a present value of 27,790. So looking at it strictly from a net present value perspective, one option has this amount, the other option has this amount. Which one would be preferable? The first one? And why do you say two?
Because one would take large money.
Exactly. So from a present value perspective, number two is cheaper. Yes. Now, as Jahaira points out, though, no, I'm sorry, number one is cheaper.
Yeah.
Number one is cheaper. But as Jahaira points out, that one requires God bless you, we use all the money we have in the bank right now, which is probably not a good idea if we're already having money problems, right? But the answer for this one, just looking from a present value perspective, not factoring in other considerations like our bank account balance, the lower cost is going to be option one. If it were my decision, I'd definitely go option two. Because also, you know, if you've got 3 years to earn the money, that's a lot of time that you can build your business up and try to get back on your feet, right? Whereas you only have 2 years and you're spending all your cash. So yeah, option one is not that good, but from a present value perspective, it's the cheaper way to go. All right, questions or comments on this problem? Just check the calculations there. Yep, exactly right. Okay. All right. And let's see what's next. Oh, yeah, IRR. Okay. All right. So this is the one I mentioned. We're not going to calculate this manually. Don't even ask me how. I don't know. But spreadsheets do it for us quite easily. Oh, there is one way to do it using the table sometimes. It doesn't always work, but here's one thing you can do. First of all, find your present value factor. Now remember how in the tables, the answer, like when you find the column and the row and you find the factor, right? So that's what this is saying. Find out what your present value factor is, so then you can then go to the table and locate it. And the way you would do that, take your initial investment, divide by your annual net cash flows. That gives you a present value factor. I think we've got an example. Here it is. Here's an example. If we have an investment of $312,000 and net cash flow per year, $49,944. We simply divide the investment by the net cash flow. We get this number, 6.247. That is a factor that we can look up on our table. We go to present value of an annuity table. We go to the I think that's a typo because here it says 6%, here it says 8%. We go to the 8% column. Oh, no, I'm sorry. We go to the, I know what they're saying. We go to the year 9. It's a 9-year investment. Okay, so we go present value of an annuity, go down to the 9, and then we just look for that factor. And this is why it doesn't always work, because what if your number is not exactly what's there? But in this case, bingo, we have the exact number. 6.247 is here, which tells us then that this IRR is 8%. So that's one way you might be able to figure out your IRR without a spreadsheet. And in this case, the minimum return is 6% for this company. So an IRR of 8 would be acceptable because it's more than 6. Okay. So again, what you do, you find your present value factor by taking the investment, dividing it by the annual cash flows. You go to the present value of an annuity table, go to the right year, right? In this case, it was a 9-year investment. So we went to year 9, find that factor or something close to it, and that tells you what your IRR would be. We'll practice that in the problem set. So here's a question for you to ponder. Let's say you can only do one project. You've looked at 2 different options. One of them has an NPV of $45,000. And it has an IRR somewhere between 5 and 8%. Then you've got a second option with a lower NPV, but a higher IRR. So which do you do? So you could argue either way, right? They're telling you different things. The net present value is expressed as a dollar amount, right? Whereas the IRR is expressed as a percentage. Looking at this, it's a difference of $10,000 in net present value. That's not, I mean, for a business, that's not a huge amount of money. I might lean towards the one with the higher IRR, especially since the first one, they gave us a range somewhere between 5 and 8%. With my luck, it would end up being 5%. So I think I'd rather play it safe and go with the one that's offering a 10% IRR. But you could argue either way. There's no right or wrong answer. Okay, so let's look at our different methods. We have the payback method, which does not use the time value of money, right? Very simple calculation. It just gives you a rough idea of how soon this investment will pay itself back. And you can use it to screen out certain opportunities that maybe don't meet your minimum expectation. Same thing with ARR. It also does not involve the time value of money. It gives you a basic percentage that you might expect to earn. However, it's just a very rough and simple calculation, probably not super precise. But again, you could screen out some possibilities that don't meet your minimum requirement. But then we get into time value of money, right? And for long-term projects, it definitely makes sense to factor that in. So as it says here, net present value compares future earnings with today's value. You're taking that future amount, discounting it back to today, which lets you then compare your options side by side, even if they're over different lengths of time. You're comparing net present value from one with net present value for the other. And then we have IRR, also considers the time value of money. It gives you a percentage rate. And as it says, you can compare different size investments. Like in that example we saw, we have two different net present values, and they also had two different IRRs, right? So you can use that to help make your decision between the two options. So in this chapter, we've looked at how we can help in making these capital investment decisions, right? What tools, analytical tools do we have to help make these decisions? Capital investment decisions are when you're making a large investment over a long period of time, right? So you want to screen out those options that don't meet your basic requirements. Then you want to, you could use the payback method or ARR, as we just discussed, to do that. But because $1 today is worth a different amount, gentlemen, it's really distracting. You can just have the conversation outside, okay? So $1 today is worth a different amount than $1 in the future, right? Because of the ability to invest, and of course, because of other factors like inflation, but primarily because for companies, they want to maximize their dollar, right? So if they've got an opportunity to invest it in one way compared with another opportunity to invest, they want to be able to compare and see what kind of return they're going to get, factoring in the time involved. So that's where net present value and IRR come in. Net present value lets us discount cash flows to today and then take out the initial cost. And then IRR gives us a percentage rate to see how profitable an investment is. So that's what we've covered in this chapter. Any questions, any comments? All right. So let's go to exercise 14.